All right, so we had a little bit of some technical issues going on right there, but we seem to have got them resolved. I was doing another hit right before this got started, and apparently our video switcher was not connecting, so our crack production staff thought this wasn't going to happen. I am here. I have no idea whether anyone's going to watch. But if you are, we're going to chat today on Open Interest. All right, normally I would say, hello everybody and welcome, but I don't know whether there's anybody watching today because since we had a little bit of a switcher problem, we thought that maybe we weren't going to have anybody watching, but supposedly I'm hearing that there's 17 people here, so you got me all to yourself. And I'm also trying to boot up my social media thing here so I can see your messages, but that also, for reasons unknown, doesn't seem to be working. So I'm trying to get you. There we go. Okay. All right. So let's talk a little bit about a couple of things. I had come up with and actually published an article, which I think may have gone up on CNBC. I don't know if it did or did not. About. And I thought it had some interesting graphics, which showed the relative performance of some factors. So all of you watching regularly will know that the way I start my day generally is by going, if we pull up my screen, to this function here in my Bloomberg terminal, which allows me to screen by certain investment factors and criteria. If you're looking at this application, one of the things you're going to see is that there are these weights up here at the top, which tell us which of these various factors actually indicate that a factor has a positive result over the course of time and improves investment results. Now, one of the things that I was able to do recently was take a look at the relative performance of some of these things so that we can see them a little bit more clearly. And I'm going to try to bump this up so we get a better look. All right, so here's an example. And this one actually kind of surprised me. So what this is, in the orange here, is the performance of stocks that have very low implied volatility, realized volatility spread. So the implied volatility that's being looked at is the 3-month implied volatility versus the 30-day trailing realized volatility. And it takes a look at the entire U.S. universe of stocks and says, okay, we're going to break that by rank. So we're just going to sort them. So in this particular instance, the smaller this number is, the better. That could even be a negative number. So if realized volatility is higher than implied, that would rank higher. So you have and you break it into quintiles and evaluate the performance. And what's interesting, and this really surprised me, was that if you took a look at the performance last year, 2025, that's what we're looking at here. This is actually from December 1st through of 2024 to December 1st of 2025. If you had bought the top quintile of stocks where realized volatility was very high relative to options prices, you'd have gotten the orange line. And if you bought the lowest quintile, you would have gotten the blue line. And what you can see is that the top quintile outperformed the S&P by a considerable amount. It was up more than 25% on the year. So outperformed the S&P by, which was up, call it 17, by 8% over the course of the year. And the bottom quintile had very bad performance and actually didn't even keep up with the amount of money that you would have earned in interest on the same investment amount. So I thought that was kind of interesting. And I thought this was kind of an interesting way to display it. Here is the out or underperformance by month. This I thought was kind of helpful because what it does is it tells us how not only how much it outperformed, but whether it did so regularly or not. And one of the things you're going to notice here is that this particular metric, this factor, outperformed 9 months out of 12. I think it's kind of interesting and maybe not that surprising that the bulk of that outperformance came in this stretch right here. And what was this stretch? Well, this is the post-Liberation Day stretch. So back on April 8th of last year, that's when we got that tariff tantrum, and the markets rolled over terribly, and then they bounced back violently. Notice something here is that this is not just a beta consideration. It is not simply that you're getting stocks that are moving around more violently, so you would expect to outperform when the market's up if you're in high beta, right? So if you have 1.5 beta, market's up 16, 17%, 25% year-to-date total returns might not seem that surprising. What's interesting to me is that these companies actually outperformed on the way down as well. They didn't fall as much as these other companies did. They started to recover more quickly. Notice that right here, these companies were down 6.9%. A month later, they were down just 6.3%, whereas these other underperforming companies were down 9.6%, and that performance got progressively worse. In fact, they were down another 200 basis points just a month later. And I think the reason for this is that what you're dealing with are the best performing companies which didn't really have much of a tariff impact at all. And another way for me to put this is, as we look at this and we think, all right, well, everyone's looking at the S&P broadly and they're saying the S&P was up 17%. Turns out that concerns about tariffs and things like this were kind of a non-starter, were a big nothing burger. S&P still had a great year. I would actually suggest that what really happened is you had this wild bifurcation. You had companies, and I think this spread just happened to pick this up, but it's obviously evidence that there were very much some have and have-nots. There are 200 stocks in each of these lines. So this is not like an arbitrary thing where you're saying, okay, well, there's just one or two stocks. There's 200 stocks in the orange group. There are 200 stocks in the blue group. And very clearly, there were some haves and have-nots. And we can see that most of the outperformance took place in and around that sort of tariff tantrum era. Okay. This one is also going to be a little bit hard to divine, but I want everybody to get a good look at it if they can. And I thought this was kind of interesting. This is higher free cash flow to enterprise value. And now we're looking at a 10-year history. And what we can see is that there are more outperformance than there are underperformance months. So this is 120 months in this whole period right here. This is 120 months going back 10 years. And you can see that there were more periods of time when higher free cash flow to enterprise value, which is another way of saying your free cash flow yield, was a net positive. But on any given month, it was a very poor predictor. You know, you can take a look at the beginning right here. Beginning of 2016, what do we get? We had 2 months of outperformance, followed by, what's this? 4 months of significant underperformance. Up 1, down 1. Up 3, down 1. The short version is that what we find is that the cumulative effect of choosing companies that have very nice free cash flow yield, and those who've watched this channel frequently will know that this is something I'm always looking at. And it is not, I'm not looking at that because of this chart. I created this chart because it's something I often look at, and I was thinking, okay, well, that's a fundamental viewpoint. I assume it doesn't have very good predictive qualities, and it clearly does not, but it has very good cumulative qualities. In fact, I was looking at the top quintile. So for the Russell 1000, going back over this period of time, and I said, okay, if I took the companies that had the the top 200 out of 1,000 companies, and just was adjusting this every month. So I always had the top 200 companies at the beginning of every month in terms of their free cash flow yield. How would I have done with those 200 stocks relative to owning the Russell 1000 overall? So I'm just taking the top quintile, free cash flow. On any given month, it's a coin flip. Actually, it's not quite a coin flip. 52% of the time you outperform, which is very, over 120 flips. It's close to 50-50 as you're going to get. But the cumulative effect was actually pronounced. 320 some odd percent total returns for the top quintile of free cash flow yield to enterprise value over a 10-year period versus something like, well, let's just pull it up. I'll just double check this number. And I believe that the total returns for the Russell, and I think I did this through here, so we'll just go back to 12/31/2015. 200. So this is the number that we're really looking at because we didn't assume dividend reinvestment. 264%. So that means that having the top 200, the top quintile in terms of free cash flow yield, outperformed the broad index over a 10-year period by 55%. That is material. Okay? That is significant outperformance. And what it does is it kind of goes to one of the points that we talk about on this channel quite a lot, which is that start with a universe of stocks that you like for fundamental reasons, and then start working from that point further down to, well, how's the timing for this subset right here and now? Because what we also know, we saw from this first chart that something as unusual, for example, as comparing realized to implied, actually has much better short-term predictive capability than a more fundamental thing would have. Here's another example of monthly performance, last 12-month sales growth outpacing 5-year sales growth. And what you see is that companies whose trailing 12-month sales growth exceeds their 5-year CAGR outperformed. And in some cases, quite significantly. This is really looking at the periodicity of outperformance relative to the cumulative total return benefit of implementing this. Sales revisions. Another example. Like, you would happily take the over on positive sales revisions once you've seen a chart like this. And here's another one. Higher RSI. So higher RSI, all else equal, did you lose sometimes if you chose stocks with, from the top quintile relative to the bottom? Yeah, you lost here and you lost here. But you won more often than you lost, and you won more when you won than you lost when you didn't. In fact, the worst period of going with higher RSIs underperformed by just under 2.5%. And we can see that there were 4 months throughout the year where it outperformed by more than that amount. So what are we getting at here? What we're getting at is that there's a lot of data that is consistent with the approach that you want to narrow the subset of stocks that you're looking at from a fundamental perspective to start, but that when it comes to how these strategies are likely to perform over the subsequent 30 trading days, that, and this is probably not coming as news to any of you, but it just reaffirms it and kind of reaffirms the approach, that fundamentals don't really play in that much when it comes to month-over-month performance. So find a universe of stocks that you like, and then start taking a look at some of these other factors. Okay, so we are going to do that when we look at these stocks and try to answer some of your questions. Okay. So Mike is still on another broadcast. Oh, that's actually from the production staff. Yeah. And no, obviously it's not canceled. We're here. Stephen, okay, we're hanging on. Well, for those of you who stuck around, thank you for doing that. Okay, but actually I see a question up here that I think is well worth taking. I'm going to go from the top here because this is about SanDisk. Eric is asking, SanDisk has gone parabolic like Micron, 1 month falls roughly 110% with earnings expected on January 29th. Thoughts on the name? Well, let's take a peek. And actually, well, let's take a look at RSI first, because you were talking about it going parabolic. So, as you point out, it certainly has really taken off. Now, one of the things that we pointed out in that sort of preamble was that relative strength can be a positive. In general, it is a positive. There are some exceptions. Oh, yes. This is actually valuable. I want to pull this up. Let me see if I can find it, because I thought this was quite interesting. Here we are. So this kind of goes to what we're talking about. So if we take a look, in this case, I was looking at Alcoa. And if you look at the top quintile of RSI for Alcoa, indeed its performance is better than the 30-day average returns for Alcoa in general. And this is going to come back to my SanDisk thing, and maybe we can work through this exercise together. We'll figure it out. However, if relative strength is a good thing, can there be too much of a good thing? And the short version is yes. Now, it's probably a little bit hard to make out from this. I'm going to try to blow this up so it can take up as much of the screen as we can get so you guys can see what's happening here. And I'm going to try to make an annotation on or about a 0 return. That's going to be right around, that's not a very straight line. Okay, but it's in there. Now, if you look at this distribution and you say, okay, is this a really compelling bet to go long a stock, it doesn't really matter what stock it is, that has a distribution like this? How often am I going to end up doing better in something like this than just buying the S&P? So the S&P is up over any 30-day period about 58% of the time, and probably by an average of just shy of 100 basis points. This distribution, for what it's worth, actually has a negative average rate of return, about negative 17 basis points. And what this is when, in this case, Alcoa is in the very top decile, price divided by 50-day moving average. What are we doing? All we're doing is we're just saying we're taking the current price, we're dividing it by the 50-day moving average over a lengthy period of time, breaking that into deciles and saying, okay, what are the average returns for that stock when it gets to that level? Let's work through an example together, and I hadn't done it yet, so we might as well use SanDisk. So we're going to do that right now since we got a question, and why the heck not? So we're just going to get the last price for SanDisk for as far back as we can get it. And then we're going to go through the exercise so you guys can sort of figure out what I was doing. I'll just do the whole thing manually right here and now, and we'll do it together. Unless I just did something, what did I do? Why didn't that work? So, what are you doing? You're doing nothing. That's not what we want. There's nothing in that cell. I have the stock, I have the last price, I have a starting date, and I have an end date. Enter. What did I do differently this time? Who knows? Okay. So here we have the prices, and this only goes back to, okay, so we're not going to have much of a, oh, yeah, that's right. They were just spun off. That's right. Okay. That's the reason we had a corporate action. So we're not going to have a whole, yeah, this is a little bit problematic because we've got less than a year's worth of data. But I don't know. We'll do it anyway. All right, so we'll take 50 trading days, and we'll just use that as, that's going to be right down here. And this is just going to be that number divided by this. Okay, so that's that ratio that I was just talking about. And this is going to give us a ranking mechanism. All right, so now unfortunately this is not a really big data set. So in the Alcoa case, I actually had daily prices going all the way back to the to early 1980. So I had a lot of trading days. Here, 180 trading days. It's not phenomenal in terms of the size of that as a data set. But we'll do the work anyway. Now I'm just going to replace this with values because we're going to be doing a little bit of sorting on this in a moment. So hopefully there's no formulas in here. There is actually another formula that I want to do now, which is now I actually want to say, okay, well, what were the forward-looking 30-day returns? So we're going to go up to the 28th of May. So that's our forward-looking returns now. There's going to be a bunch of stuff I have to get rid of down here because obviously it can't look forward. All right. So now we can actually sort based on column D. And we can take a look at, where we, and oh, by the way, we should also see where we are relative to the 50-day right now. So I can take the 50-day moving average that we are in at the moment. I should have checked to see what that was, but it's fine. So we're just going to rank this as, how many days do we have here? We have 158 days. Oh, whoops, I have to rank these. So if you're working at home and you're just saying, okay, well, how did he do this and what's he... Again, I would not normally use a data set quite as small as this for this exercise. But I think it's helpful. So this is kind of like the percentile that we're in. And then we're just going to do a quick subtotal so we can see what the average return is for this subset. Can you believe it? That's the, I mean, again, we have a really narrow data set here. And now what we're going to do is we can actually now very easily see what the respective performance is for a different, for different deciles. And I'll show you what I mean. I'll just go in here. I'm going to filter this. And so we can see that the total returns over 30 days is 40%. But again, that's... And if we're in the top decile, which is a narrow set of days, that drops to 29%. The other thing I do in these cases is I'll usually create a histogram and say, okay, well, what percentage of the time was it up versus down? And generally what you're going to find is that when you land in this top decile, the numbers tend to be a little bit less attractive. So let's see where this would land, by the way, if we were comparing this to its 50, and then we can see, well, what decile would it be in if we had one? And we've got the 50 in here. I'm just going to get rid of these other numbers because we don't really care that much about those for this piece of work. And that number is a lot. You can see it. So the stock's trading 390. Does it look overextended? I think the short version is yes. It's going to be 390 over the 50-day. I'll round that up and call it 243. 60% above. So, actually, you know what? Maybe that's, I mean, again, it's a limited data set. That's kind of the problem that we're contending with. But let's take a look now. What would that get us down to? Yeah, I mean, believe it or not, I mean, because we just don't have that much of an operating history, it's not as insane as you might think. So we're just going to... I mean, I guess the stock has basically been parabolic since it started trading. Yeah. As a... So, let's take a look at their fundamentals as well. I don't know that we can really make it too much of a determination based on the limited operating history. This is something that Carter Worth will often talk about. It's hard. Can't really look at technicals too much when... this is also an interesting thing, too. Let's just take a look at this for a moment, if we will. So remember we were talking about free cash flow yield. This is, if we're looking at the next 12 months, it's going to be a blend of these numbers. In fact, actually, we should put this into quarters. And I'm going to, this is the quarter, that quarter hasn't been reported, but it's really these quarters here, the next four, that I like to look at. And what have we got here? I'm going to round that, call it 600. Yeah, 600 million, 1.1 billion, 1.65, and another 8, so 2.5. So 2.5 billion in free cash flow versus 50. I mean, you're dealing with almost a 5% free cash flow yield over the course of the next year. So basically this year, 2026, that's pretty solid. And exceptional growth on the top line. It kind of adheres to everything else we sort of like. Let's take a look at what is anticipated for earnings. Again, very limited operating history. Options market implying 11.5% according to Bloomberg. Is that true? Let's see. We don't have... Let's see. Go here to the 30th. Stock's 390, round numbers. We'll call the straddle... I'm going to call that $82. You know what also annoys me is what did I... Oh, I was missing my calculator. I can't live without this thing. So the options market's implying a move of 21%. Wow. 21% higher or lower within the next 18 days. I like the fundamentals. I can't really make a judgment from a technical standpoint because we have such a limited history. And it does look stretched, but it doesn't look crazy in terms of valuation. All else equal, you like kind of the RSI higher relative to lower because it's something that's showing relative strength. So the question you ask yourself is, over the next 30 days, unless I had a bigger data set to say what really extended meant in here, do you want to own stocks that are exhibiting positive relative strength or negative? Positive is clearly the answer. But this thing has had quite a stretch. Let me just check one final set. I don't know whether Bloomberg's data is going to have much in terms of technical analysis for us, given the limited operating history. Well, there's your answer. So there's a lot of gaps in here, down here as we can see. So those don't have sufficient operating history. All of the best performing technical indicators remain positive. But given the kinds of moves that we've seen in it, this might be the type of name where one would either contemplate, if you've been fortunate enough to own the stock, maybe putting a put spread collar around it going into the print. As an alternative to owning the stock, something like a call spread risky might not be a bad idea. Let's take a look at the put spread collar first. We'll use Feb 27th because put spread collars, we're going to use these February options because a put spread collar or a call spread risk reversal is generally going to be... Now, here's the interesting thing, is that you'll notice that here, again, technical indicators are positive. Oh, they are also looking at... So options play by default. Notice that it uses relative strength in a decile kind of a ranking mechanism. So 10 out of 10. It's in the top decile. And if you happen to use this application, you can take a look over here and just say it's extremely bullish, exhibited signs of a potential reversal into a bearish trend. So that would be consistent. Notice that the strategies it identifies by default are a put spread and so on. This is I don't expect most people to simply get out of stocks that they like and have owned simply because they perform so well. In fact, I actually think that's a very bad idea. But I also will recognize that there are moments in time when you say, this thing has just, maybe it's gotten a little bit ahead of itself, and therefore I am willing to forego a little bit of upside just so I have some downside protection in the event that this gives a little back on an upcoming catalyst. So how would something like that work? I'm going to put bullish in here because in general, I think the story still remains positive. But if you own the stock, what might you consider? I think Feb 27th, these weekly options, 46 days to go. When you use a put spread collar, you are short more options than you're long. I think 6-7 weeks is probably a good time to think about. You're looking for a little bit of a vol crush potentially here as well. So what would you be thinking about doing is maybe buying this 380 put, and then we're going to try to do as much of an offset as we can by selling a call and a put that add up to approximately that amount of money. We're looking for about $25 for each leg. We can adjust this in just a moment. Bear in mind that I think these wings are going to come in a little bit harder. So even if this strategy right here, we'll go to 500. Even if this strategy has a mild debit, this one comes in at about even at the midpoint. So the February 325, 380, 500 put spread collar would provide some downside protection. And here's the thing. This is going to be imperfect. So that's going to give you about, we'll call it 16% protection to the downside. And this thing can clearly move every bit of that and a whole lot more. So, this is not, don't think of this as, oh, are we going to get all the protection we want? No, all we're trying to do is create a little bit of potential asymmetry. Realistically, could this thing fall 30% or so over the course of the next 6 weeks? Sure, it could. It has demonstrated as much by moving that much or more. That would take you down to 273, which is well below the lower strike. But think about this. If it did, then you're taking about $50 worth of downside risk on a $115 downside move. And, you're still preserving, in this case, $110 worth of upside. So this is a trade that you could put on that would give you some downside protection and give you some upside participation, asymmetry, going into the print. All right, let's say you don't have a position in the stock, but you like that risk-reward payoff. How do you structure it? Well, here you would do a call spread risk reversal of similar time to expiration. Now you're going to buy a call, probably just slightly out of the money. We'll use the 400s. And again, we're going to do the exact same thing. So we're going to try to sell a downside put. We're again looking for a comparable amount of money. You would actually sell the same strikes, and you're going to get a very similar risk-reward relationship. We were looking at the 325s and the 500s, and you end up with something that looks like that. Okay? And then you can tinker or toy with this to your heart's content. You decide you want a little bit more downside protection, but you don't want to have a big premium outlay. You can just take this in a little bit and say, okay, you know what, I'm just interested in participation up to, call it a 20% upside. 20% upside on that is going to be, we'll call it $75 or something like that. So, even if you got up to, like, say, these 470s, now I've got a net credit. I can actually take this down now. Maybe I'll go out to the 300s or something like that, and you end up with something that looks a bit like this. So that's kind of the way that I would probably play this, because I think the fundamental story remains intact. It still has a lot of momentum, but it is in that top decile. I used Alcoa as an example. I have many others. It's going to be it's not worth our time to go through them. You guys know this already. Your intuition is probably there. That there is such a thing as stocks getting a little bit too extended. Is this one too extended? I don't know. But it is up there. It has had a heck of a run. And, there is an old saying that bulls make money and bears make money and pigs get slaughtered. That might be appropriate in this particular case. But the underpinning story, if I didn't see the price chart and all I did was look at the fundamentals, I would say I like it. It's seeing that parabolic upshoot that makes me a little bit more anxious, though, and I don't have a whole lot of technical history to work with, so I apologize for that. I wish I had sort of something a little bit more concrete, but I think that probably gives you a sense of things. Okay, so let's have a peek here. Sicilian Ambassador. Hi, Mike. I own GUI, Fibby, Misty, Coney, Ulti. The dividend payments from the first week in December to the first week in January dropped by 2/3. Have the dividends been adjusted to preserve NAV? So the obviously preserving NAV in the yield max funds is something that one wants to do for sure. What is being paid out is going to be a function of the total returns of the underpinning funds in those cases. So when Jay and the rest of the investment team are making a determination about what will be distributed in those funds that have distributions to make, two things are going to be guiding that, and that is the relative performance of the fund to the underlying asset or assets, and the amount of premium that was collected on the options that were sold to generate yield. Now, in the case of all of these funds, as we just discussed, that late December and through that first week that incorporated the new year, there were fewer trading days, and in fact, we actually had a 5-day trailing level of the VIX. So the 5-day moving average of the VIX dropped below 14 at the end of December for the first time in just over a year. So it was actually lower than it was during the same period in 2024, in late 2025. All that's telling you is that options premiums were somewhat lower than they had been. And, that impacted how much premium was being collected. But the other thing that's going to impact results is how the underlying assets do. And so there is a desire to try to, keep the underpinning assets as stable as they can be, bearing in mind that if you realize gains, you do need to distribute those gains, or at least 90% of them, or else you're going to be subject to, double taxation, which is not a result that anybody wants. Okay. Dividend degenerates. With JP Morgan down today, what do you think about a January 16th, 315, 305 put spread? Let's have a look. Look, I mean, all these banks, by the way, they had a great, a great year in 2025. And, a lot of the sort of the fundamentals there remain intact. But if we take a look at so this is going to be a comparison not of its valuation on a standalone basis, but all we're going to look here is say, okay, where are JP Morgan's valuations relative to its own history? And this is kind of where we're at right here, right? So on a price to forward earnings going out 1 year, a little richer than it has been. So is it super expensive? No, but is it a little bit more expensive than it has been over the course of the last 5 years? Yes. I think most people would say that when it comes to the banks, one of the things they like to look at is the price to book value. JP Morgan typically trades at a premium to the group. It does now. It's at about 2.6 times book. You can see that the average for the sector overall is about 1.8. I actually, let's see, where's Wells in this list? Yeah, JP Morgan, by the way, JP Morgan, for what it's worth, is the one that kicks off. It now kicks off the earnings season. It used to be, once upon a time, it used to be Alcoa, but now this basically marks the official beginning of the earnings season. So what's kind of interesting here is that, we're talking about this, but it's a little bit of an academic question because, oh, that's true. You could be asking about something that you put on already. Whether or not that makes sense is really going to be a function of this portion, which is, are the options on JP Morgan implying a larger than average move? Or if it does, is it really meaningful? And the short version is not particularly. So the average move over the course of the last 10 years is 2.2% the day after they report. And the options market right now is implying 3.2, 3.3 in that neighborhood. Does that mean you are overpaying if you bought a put spread on JP Morgan going into this print? Not really. I don't think that really makes that much of a difference. Take a look at the last 8 quarters, and you can see we had, a 4% move here, a bigger than 4% move here. We had a greater than 6% move here. So I don't think if you bought that put spread, and also the put spread's mitigating some of the expense anyway because it's a spread, not an absolute. It's not like you bought a straddle or something like that. So do I think it's a bad call to have a put spread on JP Morgan here? No, I don't expect it to move a whole lot. Here's what these technical indicators have to say about it. So yeah, I think that's a fine trade. I don't think there's anything wrong with that. But I mean, I'm not sure it makes a huge bit of difference for me to frame this up for everybody. I'll put it together anyway. Up. Oh, you were using a put credit spread. Well, again, it's this kind of the same thing. Like, I think the options are very reasonably priced here. But I don't think I'm going to put it in. And I'm going to talk a little bit about the rationale. So you were selling you're looking at selling the 315. These are puts. Selling the 315, 305. Is that right? I'm not crazy about this risk-reward relationship, I have to say. Did I put that in right? Yeah, 315, 305. So you're risking, in round numbers, I'd like to just call this $1.50 credit on a $10 spread. So you're risking 8.5 to make $1.50, because this thing expires by the end of the week. So the way to think about it is it's in the money. It's going to go to its intrinsic value very, very quickly. I'm not totally enamored of being short this put spread. I thought you were talking about buying it against a potential long. And just not. That doesn't. I don't find that to be hugely compelling. We saw we had that 6.5% down move in the stock within the last 8 quarters. I'm not saying that's going to happen here, but that takes you right through that other strike. And we had 2 moves in the 4% neighborhood. Look, I mean, that's a trade that if you have it on, and again, there's nothing we're going to do about it now because they report tomorrow. So we're going to find out, and you can't trade out of it. I guess this was really a question you meant to ask me this morning, I guess. I think if you're short that put spread, odds are in your favor in one respect, which is that it's more likely than not that you get away with it based on the stock's historic performance around earnings. But the reason I don't like it as a trade is because on those instances where it didn't win, you lost it all. So therefore, the edge that you're getting is not super compelling, right? If I'm going to lose 8.5 to make $1.50, which net of commissions and slippage this way or that is really what we're talking about. You kind of need that sucker to win. You hope that thing's going to win a good percentage of the time. Let's actually, you know what? Here's the way I like to look at this, and we're going to do this right now. So I've done this before. So this is what we're going to do. We're going to say, okay, it's the day before earnings, and Friday is 3 days after. So this is our results. And we're going to just dump this into an Excel sheet. I think we are. Hopefully. There we are. So this is the returns for JP Morgan, okay? And we're going to take a look at your trade exactly. So in relative terms, if that makes sense. So we're going to take a look at, this is where JP Morgan is now. You're selling the 315, 305. So that's going to be, we're then going to, quickly pick the strikes. So it's going to be that divided by that. So that's the strike that you're short, 97%. This is the one you're long. All right. So now what we're going to do is we're going to say, all right, well, what was the stock's price there afterwards? So what is that first put going to be worth? So it's going to be worth the maximum of 0 or R string 2 minus 1 plus this number. So that's that put. All right. And same thing here. It's going to be worth 0, because these are options after all. Or S string 2 minus 1 plus that. All right. So what is that spread actually worth? It's going to be that minus that. So the average value of that spread is 30 basis points. I don't know if you can really make that out. All right. Now, you just sold that thing for $1.50, give or take. So that's 46 basis points. So by that work, you're going to squeeze out the amount of edge that you're getting. If we assume that this is, that the stock's price action over time has been relatively consistent, you are getting 17 basis points of edge over 4 trading days. All right. I don't know if everybody understood where I'm coming from there. So if anybody doesn't, just put it into the chat what I'm talking about. What am I doing here? What I'm doing is I'm saying, okay, if I had sold a put spread of comparable moneyness every single time from about this point right before they reported and waited until the expiration that took place at the end of that week, what did that put spread actually end up being worth on average? And the answer is, I'm going to round up, we'll call it 30 basis points. And what are you collecting to do it? About 46 basis points. So you're getting about 16, 17 basis points worth of edge, in theory, to do the trade, assuming that JP Morgan behaves in much the same way that it has done historically. So in total, this is 63. There's 63 periods of comparable length throughout the year. So that works out to an 8.8% annualized rate of return. So now you win. Now here's another quick point I would make, which is that so we've just figured out what the edge is as 0.0016, but all right. This is equal to U1 minus that. Oops, I screwed that up. So now we can actually count how many times you would win. So you're getting an 8.8% annualized rate of return to do that trade. And we're going to figure out how often you would have won. $44. Okay, that makes sense. So you win 86% of the time. You get 8. Here's the way. So we just did the math. All right. So assuming that the past is somehow indicative of how the stock typically behaves around earnings, all else equal, you're getting 8.8% annualized, and the trade wins 86% of the time. Now, the other thing we can do is we can say, and how much do you lose? We know what you make in the best case. That's 46 bips. Why don't we see what you lose on average when you lose? And there's your answer. Okay? So you win 86% of the time. You lose on average 1.6% of the stock price, which, by the way, is about 3.5 times as much as you make. So 14% of the time you're going to lose. And when you do, you lose about 3.5 times as much as you make when you win. So there you go. That's one way I like to look at trades like that. Because this is kind of binary. It's a coin flip. You'll probably notice that in general, I don't spend a lot of time trying to figure out what a company is going to do going into earnings. I spend a lot of time taking a look at technicals. I take a lot of time to look at what fundamentals I have access to. Have there been any recent revisions in earnings or revenue estimates? Those things all matter to me. But not a lot, I really think we should try to get long going into the print or something like that. Why is that? There's almost no time that you'll ever know less about a company's results than right before they report. When would we know less about how the company is doing? Would we rather try to make that binary decision about how we're going to go long or short a stock once we have as much information as we can currently have? Because here's another way to think about it. And this is a way I think about it sometimes, which is that when the company announces their results, it's not just that I have more information. Because you say, well, everybody has more information, right? You have no unique insight. That's true. To the degree that somebody does have a unique insight, though, if I do not possess one, the information asymmetry is greater right before the new information is released. And if that doesn't make sense, I'm going to try to phrase it differently. Let's assume that there are people who are tracking their affairs much more closely. Or let's say that there are people out there who have models that help them determine how much the company is making from one day to the next that are based on other observable factors, information I don't possess or that I'm not tracking. The information asymmetry is growing as time passes when no information is being released. And so it's not just that I know less about a company right before earnings than I ever will. But if there are people who have unique insights, that gap between what I know and they know is probably as wide as it's going to get. Everybody sort of gets back to the same place once we're all talking to management, once they put out their numbers. It's something to think about. Is at the end of the, doesn't mean that you should never make a determination to buy or sell a security before an event comes out. I'm just saying that, recognize, whether you think you have an edge, right? So do you have an edge here? You do. By my work, you have an edge. That edge is about 8.8% annualized. There is a better chance that you win than lose if you put on this trade. But to me, 8.8% on an options trade is not a compelling amount of yield. Many people who have watched me for a while will know that I like to see at least an equity-like rate of return, which is probably going to be edge more in the neighborhood of 12%. Just a thought. Delta, Feb. Okay. Delta, Feb, 70.65 put spread, net credit, 1.67. I like it. 33.4% of the width. So this is just a better risk reward. And it's not just a better risk reward because you're getting a bigger percentage of the distance between the strikes. It's a better risk reward because as the stock declines, that is not going to go straight to intrinsic value. So it is not simply that it's worth $1.67. I collect $1.67 or it's worth $5. That's not the way that's going to work. So I think that's pretty good. And I apologize that we joined a little bit late. We have chewed up a little, basically the hour that I normally dedicate. So again, apologize for all the mess. We had a little bit of a snafu here. I was doing an earlier video and I did not realize my switcher had switched itself off. So the production staff actually couldn't see me and they just assumed I wasn't doing it because I was dead as far as they were concerned. But for those of you who stuck around, even after you got a pop-up message that said I wasn't going to be around, your faith, was it rewarded? I don't know. You can decide whether you thought this was good or bad. Either way, you can put your comments in. because I realized I was a little less prepared than I would normally be because of those things. But I appreciate you guys sticking around for it. Hopefully we're going to have office hours. I'll double check with Mark if he's available tomorrow. And at the very least, you can come back for open mic again on Wednesday. I look forward to seeing you here then. Thanks for watching.